me do my two-step.
All right, welcome back to the channel. Before we get started, I want you to hit that like button, subscribe to the channel, and share the video. So a lot of times when guys like myself start to teach options trading or trading in general, or and this is what we do, some, in all fairness, actually show you where they have lost money, or they talk about how they've lost money. And I want to join the ranks of those guys who talk about losing money, because let me tell you something. Last Friday, I lost money. I lost $493. Now, that wasn't a net loss of $493. That was a gross loss of $493, because like I told you, I do trade out of multiple accounts. I did finish out the day plus 120. Because I did well in the other accounts, and I didn't put that same trade on, but I did lose money. So let's talk about it. So the whole point of this video today is not to teach you one aspect of options trading that's very, very important, and actually is trading, period. So when you start trading, you need a trade plan. And I will let you know, there's when I messed up, and this is all my fault. I lost the money, not because I did everything I was supposed to do and the market just went against me. No, that's not it. I didn't do everything. Matter of fact, I did everything you wasn't supposed to do, and let's talk about it. All right, so this is what happened. When you first start trading options, right? You need what's called a trade plan. Okay. Okay, so a trade plan, what is that? A trade plan defines your risk. Meaning it lets you know how much money you're going to invest and everything. But a trade plan also dictates your behavior when you're not trading. Meaning, I'm going to wake up at this particular time. I'm going to do these fundamental analysis. I'm going to check Wall Street Journal. I'm going to check Market Watch. I'm going to check Yahoo Finance. I'm going to check CNBC News. I'm going to do all these things on the weekend, and I'm going to select 5 stocks that I want to work with, the best 5 stocks based on the strategies that I want to put on in the upcoming week, right? Now, also, you have implied volatility figured into the plan. So I'm not going to trade an option that has a high implied volatility that's higher than 30%, right? Based on the strategy I like to use, which is the iron condor. And even though I tell you, you want to close your options early and just go on and collect a couple of dollars. And other traders will tell you the same thing. Go ahead and close your options out early. You don't have to do that with the iron condor if you select the correct short strikes. Okay. Well, other part of that plan. So we've covered how much you're going to invest. We covered what time you're going to get up in the morning. Yes, that's the other one. The time that you're actually going to wake up. Like, what is your routine? if to be a successful trader, because let me just give you the numbers. Out of all the people who start to trade, only 10% are successful at it, and only 1%, 1 to 2% can replace their income. Out of all the people who try, 90+% of people who try to trade or start to trade, and that's day trading, options trading, any type of trading, fail, like 90+%. So the success rate is very small. So you're either going to be in the 10% or you're going to be in the, you're either going to be falling to the range of 1% to 10%. 1 to 2% being the ones who can actually generate enough income to replace current income, or 3 to 10% of the ones who they can't replace income, but they can be fairly consistent and not losing money. At the end of the year, they will have a net gain instead of a net loss at the end of the year. Or you can even consider yourself slightly successful even if you had just a mitigated net loss. Like maybe you had $10,000 in your account and you had a net loss of about $300 to $1,000. Even 3,000, net $3,000 loss over the course of a year. That's not good, but it's not terrible. Like you could blow your account up and have a net loss of everything that you put into the account. But that's not the plan. That's not what we want to do. That's not what this channel is about. This channel is about learning how to fire your boss. And I was just not good. I was not a good leader this week. I was not a good host this week. I was not whatever you want to identify with me as. I didn't do good. I have failed you guys, but I'm going to tell you so you will avoid that. So knowing all these things that we just talked about this particular trade plan, which there's more to my trade plan is very fairly complex, but also fairly simple. I mean, because it gets into, okay, if the market's like this, so if the market is bullish, then I'm going to put credit spreads and make money, or you can call it a bull put spread. If the market is bearish, then I'm going to put on a call credit spread, because I like the mitigated risk strategies. I like risk control strategies. I don't like just calls and puts. We already talked about that in previous videos. They're way too risky, and if the market turns against you, you're really going to hate life. Okay, so the iron condors, the vertical spreads, like the iron condors, the multi-leg options, that's what I like. Okay, so all of this stuff is defined in my trade plan. But this is why you follow your trade plan. I lost $493 because I didn't follow my trade plan. Why? Okay, so what was the stock? The stock was IWN, which is better known as the Russell 2000. All right, I lost with that. Okay, so, well, John, how did you lose? Easy. I don't trade when it's more than 30%. Well, the IV last Friday was 37%. Is that more than 30%? Absolutely, it's more. So then that was a bad thing. All right. The next bad thing was, normally I wake up at a certain amount of time, but in my defense, I did get awakened earlier than I normally wake up, about 2 hours earlier, and that is okay. Because for those of you who don't know, I am engaged and my fiance is not here. She is actually working in another country. So when she calls me, I'm going to wake up and tend to her. So when we got off the phone, I fell back asleep and I was able to actually go fully back to sleep. That's how long that gap was before I actually wake up and get my day started and do all these things. And I slept past the opening bell. Now, if I were awake, because I'm going to check. Soon as the opening bell, I could have saw that the position was trading against me, going in a different direction, and there's a lot of things I could have done. So with the iron condor, you can close down you leave open the problem side, go ahead and collect the credit on the side that is making money, because you're not going to lose on both sides. It's impossible, because you have a put side and you have a call side. Typically only one side is going to go, only one side can go against you. It's not typically, that's the way it works. You can't be losing and making money at the same time. The stock market doesn't work like that. It's either up or it's down. Nothing. If it's up, you're winning on the put side. If it's down, you're losing on the put side and you're winning on the call side. But you can't do both, right? So you always want to close down the side that's bad, and you always, excuse me, no, you don't want to mess with the side that's bad. You want to close down the side that's winning money and collect some type of a credit to mitigate your losses. Okay. Now, I didn't even do that. By the time I got to it, I was past what's known. Let me give you some visual here. So let's clear this. All right. So when you set up the iron condor, this we already know I can't draw. Okay. So we're gonna look at this part right here, because all right, with this, we know from previous videos, right, that outside here is bad, outside here is bad, because right here, this is your BE, okay? These are your break evens, right, on both sides. These are your break evens. Okay. If it's trading right here, then you're breaking even right here. But if it gets, and these are your short positions, so if it gets beyond the short strike, out here are your long strikes. Which should be, and out here, these have the least amount of extrinsic value left on the day of closing, and these have the most extrinsic value left at the on closing, at closing. So the closer you are, the positions that's closer to the money, they are less affected by theta time decay than those that are furthest away from the money. But that's a whole video within itself, and that's not the point of this video. Okay, so now that you have a visual up here, so you can shut down one of the sides. We'll just call this the over here. This is going to be the call side, and over here, this is going to be the put side. So this is the call side. This is where I'm in trouble, and this is the put side. This is where I was not in trouble. Okay. Now, we already said by the time I noticed this, I was already like negative $520. Negative $520. By the time I woke up, got my bearings about me, I was already negative $520. When your trade starts getting into this, what we call the Bermuda Triangle, options traders call this the Bermuda Triangle. This is where you start hoping and praying that the market comes back. Okay. So if it went against you on the put side, and once it gets here, this is where you're starting to see negative $20 in your account, or up to probably about negative $60. Okay. And as it trades closer to this line, this break-even price right here, this negative number goes up. And you're saying, well, if it's breaking even, then we're not losing money. Oh, no, it don't quite work like that. What they mean is you're not experiencing max loss, but this is also going into your danger zone right here, because see, you receive the credit when you put this trade on. So based on what the market value is, and this trade is going against you, your break-even point, it's going to shift back based on how the market is moving, based on the implied volatility, based on what's going on. You are likely to end up right here. Okay. And then you have to ask yourself, do you really? Now, if it was to expire and you are 1 cent within this, you're good, irregardless as to what this says. This would mean nothing once everything was done. If it closes, and let's say your short position here was, this is just an example. Let's say your short position here was $220, right? and then the position closed. So your short position here was a 220 strike, okay, and then while the market is open based on the IV, the computer is calculating it to go past this line before the bell sounds, and this is about what you're going to lose. So you'll start seeing it. But none of that matters if it closes at, because typically there's a little change in here, like 17 cents. If it closes at 220, if it closes at 220.16, you're good. It expires worthless. You get to keep the full credit. You get your collateral that you use, that you use to set up the trade back, and it's all good, no problem. But that's not what happened with me, and it wasn't on that side, okay? Mine was over here, and when I tell you it blew through it, man, it blew through it like I just started trading options yesterday. I don't remember the exact strike, but let's just say I think I had like I think I sold the 224 strike, and then I bought the, nope, I remember now. I sold the 225. Yep, I remember. I sold the 225, and then I bought the 226 long. Right? Well, it was out here at $227. So let's just get that out the way. If this was 226.18, give or take, and it was trading at 227, and we'll just say plus. All right. I got lucky, and it came back down to 225. And I said, well, you know what? I may stay here. I may stay here because just like I just told you, if you're just a penny within, you're good. But then but now what do we have to do? We have to go to our technicals. And when I went to the technicals, I looked at the MACD, and the MACD showed me where this was bullish, and it was definitely going to close higher. And you can go back and look on Friday, and it should have closed somewhere around 227, 228, something like that, but which is way outside of my long position. And just as a recap, we can't let this expire. Why? Because not only are you beyond your short position, you are also, it has moved above your long position. So you've got to close that position out. This is not optional. You have to close this position out. So it's another reason I want to make this video. You can't let this option expire. Matter of fact, you don't need to even wait on it to do anything within the next few minutes. Now, the chances of you getting called on this while the market is open are not high, but it could happen. And unless you have $30,000 in your account, you don't want that to happen. So just go ahead and close the position. So I went ahead and closed the position when it was back within when it got back within my short position here. So I would have time to close it. That was the smartest move. And then that's how I only ended up losing $493 instead of $520. So in the end, I violated when I wake up. I violated trading an option, using a strategy with using the strategy that I use on the stock with the implied volatility, which was higher than 30%. So this is on me. This is my fault. I can't blame anyone. This is just my fault because I violated my trading plan. And if you ask anyone who does this, especially someone who does this for a living, ask them what happens typically when you start violating your trading plan. That's when bad things happen. This is not that bad because I was able to mitigate some of my risk. So what could I have done if I didn't violate my trade plan? Well, for one, let's say I violated the implied volatility. Now, if I would have woken up and got on here, the first thing I could have done is close this side down, collected a credit. The second thing I could have done was extend this leg over here, or which even with the put side, not closing that down, I could have extended this leg out to 229 and allowed it to expire worthless. I could have done those things. I could have also closed the put side out and bought another put spread, put credit spread closer to the money, and collected some semblance of a credit to mitigate some of this, some of the potential loss, some of the potential risk. Or I could have just collected credit here by collected the credit on the put side and then closed out the call side altogether before it got out of hand. Because I was asleep. When I woke up, I was out of hand. Like I was all out of pocket. So the whole lesson for today is this: don't violate your trade plan. When you guys, and I've got a couple of guys who actually get on, who inbox me on my personal account, on my email account, and they work with me. They need to hear this, so when they watch this video, they can understand why I preach on not violating that trade plan. The one day that I violate that trade plan, I lost money. So that was the purpose of this video. Thank you so much for watching. Click like, subscribe, and share. And I will see you next time.